Welcome to The Explainer. Today, we're diving into one of the most mind-bending market moves we've seen in a long time, the incredible meteoric rise of Sandisk, trading under the ticker SNDK. You know, whenever a stock shoots up into the stratosphere seemingly overnight, it naturally triggers a massive debate. Is this just an unsustainable wave of market hype? Or are we looking at a profound, fundamental shift backed by hard data and solid business economics? Today, we're tearing down the numbers to see if this rocket ship actually has enough fuel or if it's running on pure hype.
Okay, let's dive into this. Over the past 52 weeks, Sandisk shares have surged an extraordinary 3,930%. And I really want to pause right there, because that is absolutely not a typo. You are literally looking at a scenario where you could have seen nearly 40 times your money in just a single year. Seriously, a chart going straight up like that, it stops you in your tracks. But you know, a chart is just a line on a screen. We got to figure out what's actually fueling this massive run.
Section 1. The business behind the boom.
So let's ground ourselves in reality first. Based out of Milpitas, California, Sandisk is a pure-play NAND flash memory company. Following their spin-off from Western Digital back in late 2024, they're flying completely solo on the NASDAQ now. And what do they actually do? Well, they are the critical storage backbone for our entire digital economy. Every massive server farm, your consumer electronics, and yep, those massive enterprise AI models, they all rely on this lightning-fast, high-capacity storage to even function. So, the obvious question, are they actually making any real money? Absolutely. Just look at this. In Q2 of last year, earnings per share was sitting at just 91 cents. Fast forward to Q2 2026, and that number has skyrocketed to $5.46 a share. So that crazy 3,900% stock surge, it isn't just some futuristic pipe dream. It is backed by massive, tangible profits right here, right now. And hey, it's not just the bottom line doing all the heavy lifting. That EPS jump, it's paired with a massive surge in total revenue. For Q2 2026, Sandisk's top line hit $3.03 billion. That represents an incredible 61% year-over-year increase. You know, it's one thing for a company to slash costs to make their earnings look good, but a 61% jump in actual revenue shows that demand for their flash memory isn't just growing, it is running red-hot globally.
Section 2. Unpacking the financial ratios. Now, what's really interesting about this slide is the wild juxtaposition going on in these valuation ratios. A trailing PE ratio of 47 times looks incredibly expensive at first glance, but look right below it. The forward PE is just 8.89. The market is literally pricing in explosive forward earnings. Combine that with a tiny PEG ratio of just 0.03, and honestly, the stock might actually be undervalued relative to its growth. Add in a 39% return on equity, almost 49% return on invested capital, and an essentially debt-free balance sheet, and you have a financial fortress.
Which brings us to the elephant in the room. The exact question every single investor is wondering right now. When you see returns pushing 40x in a year, backed by incredibly strong cash flows and a fortress balance sheet, you have to ask, is there still room to run, or have we already reached the peak of the mountain?
Section 3. Future potential and the AI megatrend.
Well, here is how the future is shaping up if you look at the data. Revenue is forecast to grow at 10% annually over the next 3 years. And to put that into perspective, they are easily crushing the broader tech industry's average of 6.8%. Plus, gross margins are expected to push into the 60 to 65% range for 2026 and 2027. And if you want the ultimate signal of management's confidence, they just greenlit a massive $6 billion share buyback program.
But what's the actual engine driving this whole machine? It's the AI megatrend. Think about it. Every new large language model that gets trained, every mega data center built, every single AI inference workload executed, they all demand massive amounts of lightning-fast, ultra-reliable storage. Sandisk is sitting right in the eye of this hurricane. AI is basically acting as this massive continuous tailwind for their NAND flash memory products.
Section 4. Analyst targets and risks.
And this brilliantly illustrates what the Wall Street pros are thinking. The sentiment is overwhelmingly clear. Out of 21 tracked analysts covering Sandisk, 16 rate the stock as a buy. You've got 4 holding and just one single lonely sell rating. The consensus here is incredibly bullish.
When we break down those specific analyst targets, the numbers get pretty bold. Across 22 analysts, the average 12-month price target sits at $1,609, and the highest bull case estimate? Try an astonishing $3,250. But look, we have to impartially balance these aggressive targets against the very real, tangible risks threatening the business. Because on the bearish side of things, Sandisk is facing intense competitive pressure from overseas. Plus, there's a legit risk of losing market share as they navigate a strict build-to-demand strategy.
Let's actually drill down into that bear case for a second, because it's absolutely vital to understand the full landscape. Sandisk is feeling the heat from rival NAND manufacturers in Japan, Korea, and particularly China. Bears are quick to point out that NAND spot prices have recently paused their rise. Combine that with Chinese competitors aggressively expanding their manufacturing capacity, and well, that could signal an early end to the current memory upcycle. If the amount of bits sold starts to decline quarter over quarter, a stock that has run up this fast could experience some extreme, violent volatility in the opposite direction.
So, to wrap our heads around all this, at its core, Sandisk is a high-momentum, high-growth, low-debt powerhouse. It's riding two of the most dominant secular trends of our era, AI infrastructure and the global data explosion. The profitability ratios are totally ironclad. But let's be totally clear here. Any stock that runs up nearly 4,000% guarantees extreme volatility along the way. Position sizing, if you're getting in now, is absolutely critical.
We've looked at the explosive earnings, the pristine balance sheet, the massive AI tailwinds, and those looming competitive threats from overseas. So now, it's time to apply what you've just learned to your own research. Based on the hard fundamentals versus the market hype, are you buying, holding, or staying completely on the sidelines with Sandisk? Let me know your thoughts down in the comments, and keep leaning on the data to drive your decisions. Catch you next time.